Something deeply unsettling is unfolding across global financial markets at this very moment, carrying profound consequences for the world's primary reserve currency as well as the enduring stores of value represented by gold and silver. Oil markets have experienced a sharp retreat amid fresh assertions that a critical energy choke point might soon return to normal operations. Yet the bond market continues to signal that underlying conditions remain far from stable. Long-term government debt yields in the United States stay stubbornly elevated despite the abrupt reversal in energy prices over recent sessions, while an extraordinary development in Asia threatens to compel the central bank of the world's largest economy into expansive dollar creation on a significant scale without any formal declaration of renewed large-scale asset purchases. Should this trajectory persist, observers may be witnessing the initial phases of a broader systemic disruption that is yet to receive full recognition in precious metals pricing, but could soon command attention. Consider first the latest developments surrounding the vital waterway through which a substantial share of global petroleum supplies must pass. Recent statements from senior officials suggested that an arrangement permitting freer transit could materialize within a short time frame, prompting an immediate and pronounced decline in crude valuations. Such an outcome would indeed eliminate one of the most significant geopolitical risk premiums currently embedded in energy markets. Yet caution remains warranted. Historical patterns reveal repeated cycles in which forceful rhetoric regarding potential military measures against regional infrastructure gives way to last-minute restraint, accompanied by plunging commodity prices and buoyant equity responses. Parallel episodes involving preliminary understandings have previously failed to deliver lasting resolution. Meanwhile, maritime conditions in the Persian Gulf continue to present genuine hazards. Reports persist of vessels encountering projectile strikes during transit attempts, and recent incidents involving attacks on regional installations underscore the unsettled environment. Until commercial shipping resumes secure passage in meaningful volume, assertions that the disruption has essentially concluded warrant considerable reservation. Policymakers have nevertheless achieved a measure of success in restraining energy prices well below the peaks recorded in the preceding week. Whether this outcome stems purely from algorithmic reactions to optimistic headlines, coordinated official actions, or some blend of both remains open to interpretation. What stands beyond dispute is that the same relief has not extended to fixed income markets. The yield on the longest maturity United States Treasury security offers the clearest warning signal. Although this benchmark has retreated modestly alongside the oil decline, it continues to trade near thresholds last observed in the period preceding the major financial dislocation of nearly 2 decades ago. This persistence constitutes a substantial challenge given the dramatically expanded public debt burden relative to that earlier era. Elevated long-term rates impose rising servicing costs that have already surpassed $1 trillion annually for the federal government alone. The effects cascade far beyond official accounts, influencing residential mortgage rates, corporate funding expenses, commercial property refinancing, household credit availability, and the broader capacity of private entities to roll over vast outstanding obligations across the economy. The energy disruption therefore transcends a simple supply narrative. It functions as a potential catalyst capable of exposing vulnerabilities within the sovereign debt structure itself. Attention now turns to Asia, where the Japanese currency has experienced a pronounced depreciation, approaching multi-decade troughs relative to the dollar. Authorities there have expended considerable resources in defense of the exchange rate, and for the first time in many years, the United States participated in coordinated foreign exchange operations. Notably, the American contribution reportedly involved dispositions of European currency rather than direct dollar sales, illustrating the intricate constraints confronting policymakers who must simultaneously manage the greenback, domestic borrowing costs, and broader international liquidity conditions. Japan confronts a particularly acute dilemma because the nation relies heavily on imported energy. Rising oil prices coinciding with currency weakness produce a double burden. The commodity itself becomes costlier, while each unit of foreign currency required for purchase translates into even greater local outlays. Conventional wisdom would prescribe aggressive interest rate increases by the Japanese Monetary Authority. Yet the country carries one of the heaviest government debt loads among advanced economies. A sharp ascent in domestic yields would itself precipitate an alternative crisis. Officials therefore find themselves constrained on multiple fronts. One proposed avenue involves expansion of a specialized Federal Reserve facility known as the Foreign and International Monetary Authority's repo arrangement. This mechanism permits overseas official institutions to temporarily exchange their holdings of United States Treasury securities for dollar liquidity provided by the central bank. Japan ranks among the largest foreign owners of American government debt. Should the need for dollars to support the domestic currency become urgent, the conventional response would involve outright sales of those treasuries into the open market. Such disposals on a large scale, however, risk driving prices lower and yields higher precisely when American authorities seek to prevent further increases in borrowing costs. The facility offers an alternative path. The securities serve as collateral, dollars are advanced, and the bonds remain off the public market. In formal terms, the distinction from traditional quantitative easing remains significant. Under asset purchase programs, the central bank expands its balance sheet by acquiring securities outright. Under the repo arrangement, liquidity is created against temporary pledges, with the transaction structured to reverse. Yet, if the scale grows substantial and successive operations roll forward continuously, the practical implications for market liquidity and the size of the central bank's balance sheet begin to converge. Expansion could occur without any public announcement that a new phase of balance sheet growth has commenced. Step back and observe the interconnected sequence. An abrupt escalation in energy prices originates from the effective closure of a pivotal global supply artery. Inflation expectations adjust upward, exerting pressure on long-term yields. Japan experiences compounded stress from costlier imports and currency depreciation, generating demand for dollar reserves. Disposal of its substantial treasury holdings would intensify upward pressure on American rates. The suggested remedy involves the Federal Reserve generating dollars against those same securities. The circular dynamic becomes evident. An energy shock fuels inflation, which destabilizes sovereign debt markets, which in turn prompts demand for official liquidity provision, which itself adds to the stock of reserves even while the original inflationary impulse has not fully dissipated. Such a configuration carries inherent risks. At present, the retreat in oil prices grants authorities a temporary window. Restraint regarding further military measures, combined with statements projecting near-term progress on the waterway, has encouraged markets to incorporate optimistic assumptions. The visible priority appears to be containment of energy costs, reflecting an understanding of the broader consequences should prices break higher once more. The critical uncertainty concerns the durability of this containment. Should an agreement fail to materialize? Should maritime attacks continue? Or should the waterway remain restricted? Energy prices could reverse course and retest recent peaks. In that scenario, the bond market, which has received only limited relief even amid the recent decline, would likely face renewed upward pressure on yields. Japan would confront additional currency and debt market stress, while other heavily indebted economies could encounter parallel difficulties. Central banks would then confront the simultaneous challenges of elevated inflation and emerging fiscal strains, an especially difficult combination. Conventional responses to inflation favor tighter financial conditions, whereas responses to debt service difficulties favor accommodation. Reconciling the two objectives proves far from straightforward. These dynamics explain the continuing rationale for maintaining physical holdings of gold and silver. Uncertainty surrounds whether projected arrangements materialize in the near term, whether energy prices stabilize at lower levels or reverse sharply higher, and precisely where stress thresholds exist within the Treasury market. What remains observable is the pattern of official responses already underway. Interventions in currency markets, efforts to discourage large-scale official sales of government securities, discussions regarding expansion of central bank liquidity facilities, and attempts to moderate energy prices, all occurring while long-term yields hover near levels associated with the prelude to the prior major financial episode. The contemporary debt burden stands markedly larger than in that earlier period. Should energy prices resume an ascent and bond yields follow, the impetus toward more assertive monetary accommodation would intensify. Historical experience indicates that when public obligations become excessively costly to service, authorities typically confront a limited set of options: outright default, sustained fiscal contraction, or progressive currency debasement. The third path has frequently proven the most politically feasible. Consequently, despite fluctuating energy headlines and intermittent projections of regional de-escalation, allocation toward physical precious metals retains appeal at prevailing valuations. These assets represent forms of money whose supply cannot expand at the discretion of any monetary authority. In an environment where systemic stability increasingly depends upon continuous official support, instruments free from that dependency offer a distinct form of resilience. Market participants monitoring these developments closely will note that recognition of the broader risks has yet to fully permeate precious metals pricing. Any acceleration in the pressures described, renewed energy spikes, further yield advances, or expansion of liquidity facilities could alter that assessment with considerable speed. The importance of the waterway itself warrants deeper examination. Roughly 1/5 of global seaborne oil trade normally traverses this narrow passage, along with significant volumes of liquefied natural gas and refined products. Any sustained interruption elevates not only crude prices, but also the costs of transportation, insurance, and alternative routing. Markets respond rapidly to shifts in perceived probability of disruption or resolution, yet physical reality on the water often lags headline narratives. Continued reports of strikes against commercial vessels indicate that risk premiums, while compressed by recent optimism, have not been eliminated. Should physical constraints reassert themselves, the transmission mechanism into broader inflation expectations would resume, placing renewed pressure on fixed income instruments already trading at elevated yields relative to recent decades. The scale of the American debt stock amplifies every incremental rise in yields. Interest expenses that once represented a modest fraction of federal outlays now rival major discretionary categories. Private sector balance sheets face parallel challenges. Households with adjustable rate mortgages or those seeking to refinance face higher payments. Corporations with substantial near-term maturities confront elevated rollover costs. Commercial real estate owners, many of whom operate with leverage calibrated to the prior low-rate regime, experience compressed valuations and tighter financing terms. Consumer credit markets tighten as lenders reassess risk under higher discount rates. These channels collectively raise the probability that an energy-driven yield spike could precipitate broader credit strains. Japan's predicament illustrates the global interconnectedness of these pressures. Decades of ultra-commoditive policy created an environment in which government debt expanded to multiples of national output, while private portfolios grew heavily reliant on low yields. Currency depreciation now raises import costs across the board, not solely energy. Attempts to support the exchange rate through direct intervention consume foreign reserves. Participation by American authorities in such operations, conducted through third currency channels, reflects the delicate balancing act required to avoid exacerbating dollar strength or domestic yield pressures. Expansion of the specialized repo facility offers a means of providing dollar liquidity without immediate market sales of treasuries, yet repeated large-scale usage would still enlarge the Federal Reserve's balance sheet and inject reserves into the system. Over time, the distinction between temporary liquidity support and more permanent accommodation can blur in the eyes of market participants evaluating inflation trajectories and currency values. Precious metals occupy a unique position within this configuration. Gold has historically performed as a monetary asset during periods when confidence in fiat arrangements comes under question, particularly when official balance sheets expand in response to fiscal or financial stress. Silver shares monetary characteristics while also retaining substantial industrial demand, creating dual sensitivity to both monetary conditions and economic activity. Current valuations relative to the expanding stock of government liabilities and the potential for further liquidity provision leave room for reappraisal should systemic pressures intensify. Physical ownership removes counterparty exposure inherent in paper claims and ensures that the asset cannot be diluted by additional issuance. Observers should also consider the feedback loops that can develop once markets begin to price these risks more fully. An initial rise in energy prices elevates inflation expectations, prompting yield increases. Higher yields strain highly leveraged borrowers and sovereign balance sheets. Official responses that expand liquidity in an attempt to stabilize debt markets can further support inflation expectations, reinforcing the original impulse. Currency markets react to relative policy trajectories and reserve flows, generating additional volatility. In such an environment, the demand for assets perceived as independent of official management can increase rapidly. Gold and silver, having served this function across centuries and monetary regimes, stand ready to absorb that demand. The absence of immediate pricing recognition in the metals markets does not imply immunity. Markets frequently lag in recognizing interconnected risks until a catalyst forces simultaneous reassessment across asset classes. The combination of elevated long-term yields, constrained policy options in major economies, and residual energy market fragility constitutes precisely such a potential catalyst. Continued monitoring of maritime conditions, yield trajectories, currency interventions, and the utilization rates of specialized liquidity facilities will provide early indications of whether the current containment holds or whether pressures reaccelerate. In summary, the present configuration features an energy market retreat that has not been mirrored in the bond market, an Asian currency under sustained pressure that invites official liquidity solutions with balance sheet implications, and a debt stock of unprecedented size relative to the yield levels now prevailing. These elements interact in ways that elevate the probability of further official accommodation even as inflationary risks from energy markets remain incompletely resolved. Physical gold and silver offer a form of monetary continuity that does not depend upon the successful navigation of these tensions by any single authority. Their role as portfolio ballast and long-term stores of purchasing power remains relevant precisely because the alternative pathways, default, austerity, or debasement, carry their own substantial costs and uncertainties. Market participants who maintain exposure to these metals position themselves for a range of outcomes in which official management of the current stresses proves more challenging than currently anticipated. The interplay between energy security and monetary stability extends beyond immediate price movements. Energy constitutes a foundational input across virtually every sector of modern economies. Sustained elevations in its cost alter relative prices, compress real incomes, and shift demand patterns. When such elevations coincide with rising debt service burdens, the capacity of households and firms to absorb the dual pressure diminishes. Governments themselves face higher interest costs at the same time that fiscal revenues may soften under slower growth. The resulting tension between the need for fiscal support and the need for monetary restraint has historically proven difficult to resolve without eventual recourse to balance sheet expansion by the monetary authority. Recognition of this historical pattern informs the continuing preference for assets whose supply remains independent of policy decisions. Custody markets provide an additional transmission channel when major economies pursue divergent policy paths or face asymmetric shocks. Exchange rate volatility can amplify domestic price pressures. A depreciating currency raises the local currency cost of imported energy and other goods, feeding into measured inflation and reinforcing the original shock. Official attempts to stabilize exchange rates through intervention consume reserves or require reciprocal actions by partner countries. When those partner countries themselves confront elevated domestic yields, the willingness to engage in large-scale support operations may be limited, prompting consideration of alternative liquidity arrangements such as the specialized repo facility. Each such arrangement, while designed to address specific frictions, contributes to the overall stock of reserves and influences perceptions of future monetary trajectories. The scale of potential utilization of such facilities merits careful attention. Japan alone holds a substantial portfolio of United States government securities. Other official institutions maintain significant exposures as well. Should multiple entities simultaneously seek dollar liquidity through collateralized channels rather than outright sales, the aggregate volume of reserves created could become material. Markets would then evaluate whether the operations remain truly temporary or whether continuous rollover effectively converts them into a more permanent feature of the financial landscape. Such evaluation would influence inflation expectations, currency valuations, and the relative attractiveness of monetary metals. Gold and silver markets themselves respond to a complex set of drivers that include real interest rates, currency movements, geopolitical risk, and official demand. Periods of rising nominal yields can exert temporary pressure if real rates also advance. Yet when yields rise primarily because of inflation concerns or fiscal stress rather than robust growth, the metals often demonstrate resilience. Moreover, any perception that official responses will ultimately lean toward accommodation tends to support longer-term demand. Physical ownership further insulates holders from the operational and counterparty risks that can emerge during periods of market stress. When paper claims may face settlement or liquidity challenges, the current environment therefore presents a confluence of factors that elevate the strategic relevance of these metals. Energy market volatility has not been fully neutralized. Long-term yields remain elevated relative to recent history and relative to the size of outstanding debt. Major economies face constrained policy options, and official discussions already contemplate expanded liquidity provision through specialized channels. These elements collectively suggest that the path toward resolution of present stresses may involve further expansion of official balance sheets and continued pressure on the purchasing power of fiat currencies. Assets whose supply cannot be increased at policy discretion stand as a logical counterpart to that trajectory. Continued observation of physical market conditions and energy, the behavior of the longest maturity government yields, the frequency and scale of currency interventions, and the reported utilization of specialized Federal Reserve facilities will supply the most direct evidence of whether the present containment proves durable. Should any of these indicators deteriorate, the transmission into precious metals markets could accelerate. In the interim, the analytical case for maintaining exposure rests upon the recognition that systemic risks have increased even while market pricing has yet to fully incorporate that increase. Physical gold and silver by their nature require no institutional intermediary to retain their monetary character and therefore offer a form of continuity that remains independent of the successful management of the tensions now visible across energy, debt, and currency markets. This assessment does not constitute a prediction of immediate crisis, but rather an identification of interconnected vulnerabilities that elevate the probability of more aggressive official responses than currently discounted. The historical record demonstrates that when debt service costs rise rapidly in an environment of elevated inflation risks, the preference for monetary accommodation frequently asserts itself. Preparation for that contingency through ownership of monetary metals whose supply remains outside official control represents a prudent response to the configuration of risks now observable. Market participants who monitor these developments with attention to the underlying mechanics rather than short-term headline fluctuations will be better positioned to interpret subsequent price action in both the energy complex and the precious metals